Our experts tonight are Robert Projeski, Managing Director at Australian Mortgage Options, and Warren McCarthy, Chief Executive Officer of LJ Hooker. So some big names in the studio tonight to answer your questions. Our phone lines are open, 1300 30 34 35, or if you prefer, you can email us too. Your call at skynews.com.au. Robert, how do you know if you're ready to buy a second property when you're looking at all your finances? How do you know?
What we normally do is we have a look at a snapshot of their current income, so look at serviceability, in other words, how much they can afford to actually repay on their own. That is, if there was no tenant there, if they're looking at an investment property point of view, how much buffer they've got there. We probably do a valuation of their existing property also to see how much equity they've got in their property, because obviously the loan repayment structure is a little bit different from an investment property as an owner-occupied property. On an owner-occupied property, we'd strongly encourage and recommend that they pay as much as they can when they can and park the bulk of the money into their owner-occupied home loan. Whereas when it's an investment property, most of the times it's normally an interest-only loan. And when it's an interest-only loan, we'd encourage them to make minimum repayments on the investment property, so therefore they can maximise their tax deductions.
And what are the common tricks or traps of buying property? Do people just get over ambitious about, add to their portfolio?
They probably need to, from what we've seen, they probably need to look at it more strictly from a business point of view. So it doesn't really matter what colour the carpet is, or the tiles on the floor or the walls. Look at it like Warren said, from a geographical point of view. So if they're thinking, could I potentially rent or live in a property like this, 9 times out of 10 say could someone else. So when they're looking at it from an investment point of view, there's 2 things to consider from an investment point of view. Warren touched on one of them earlier when he said rental income as the yield. That's great in this sort of market. Like most places in Australia today, you've got less than 1% vacancy rate. Now, less than 1%, that's probably the lowest it's been for many, many years. 3% is normally considered the norm. 2% is there's not enough property available. 1% is almost a dire straight. So from an investor's point of view, it's probably one of the best times to get in and buy, even though some places the property might be actually a bit lower. But with the rental returns going up, that's normally a good place to start. And if they're getting at a lower base, hopefully going forward, their capital growth on that property will actually end up going ahead a lot sooner. But they just need to be conscious that they're not looking at it as an unoccupied property. So it doesn't have to have the really big yard for the dog or anything like that. Most people that are looking at it from an investment point of view, generally speaking, like a 2-bedroom unit caters probably for 80% of the market, so to speak, whereas it might not be the same for someone wanting to have the family home where they might be able to raise their kids. So there's you got to weigh up the finances first and look at it from a financial point of view, other than the emotional point of view, whether you like the colour of the of the decor. 9 times out of 10, we'd probably recommend in this current market is actually fixing the rate anyway. So if you were to fix it,
now. Yep. Isn't the era of fixed rates over now?
Okay.
The top of the cycle.
There's a reason why we'd say that.
Okay.
Two factors is, one would be that people want peace of mind when they're looking at investment property. So they normally factor in, after my used to be called a 22(1)(d) tax variation, now it's known as a 15(15) tax variation, which is the tax deductions that they're likely to get in their pay packet on a regular basis, whether it's weekly, fortnightly, or monthly. So they take that into consideration, the rent into consideration. They're saying, okay, what's my shortfall, if any, and therefore what provisioning can I make to give me peace of mind going forward? And the only way to do that in this market is actually to fix it. I mean, we saw today banks have moved outside the Reserve Bank movement. So don't take the Reserve Bank as being the be-all and end-all to controlling rates in Australia today. Don't be surprised, and you might have heard anywhere else so far, but don't be surprised if the Reserve Bank going forward, if they reduce rates, if the banks don't, if they actually hold and try and retain some of that back. So just be cautious about that, Brooke.
Interesting that you make the comment, because when you speak to the economists out there and that you say, should people fix rates, they say, well, of course, we're at the top of the interest rate cycle, so something for people to be wary of there.
But they have got access. Like in today's market, you've got access. I mean, with the majors, they're hovering around 9.67 or thereabouts as standard variable rate. We can organise a fixed rate loan for less than half that. So that means like 2 rate reductions today for peace of mind between 3 to 5 years. So that gives people 0.5% discount today without any ongoing fees and charges, without having to know, well, is the current economic crisis going to get any worse, and is there going to be any potential rate increases again outside the Reserve Bank? So for the smart investors that are actually getting in now, they're getting their loans pre-approved and sitting on that and then looking at opportunities that might come up.
Yeah, good advice. Very good, because that's making headlines, those economists saying, don't bother about fixed rates these days because rates are on the way down.
They're all predicting that Reserve Bank will probably reduce rates at the next move, but don't be surprised if the majors don't drop their rates when the Reserve Bank moves.